Welcome, everyone. Welcome to this kickoff of the book Blind Spots. I'm Steve Booren, and I am grateful to be here with you today. I'm humbled that so many people have chosen to join us to invest this time today. We'll visit a little bit about the book. I'll visit a little bit about the book for about 30 to 40 minutes. There may be some questions that arise from today's conversation, and I'm just really honored that you've chosen to join us. Just as a reminder, if you would make sure that you stay muted, that would be great. That way we don't have any background noise that we are sharing or resharing. Also, just so that you are aware, this meeting, this Zoom session is being recorded, and there will be a link that'll be available if you care to see it again, or if you want to share it with others. We'll have that for you in a day or so. So with that, I think I'll kind of kick this off. So what's the reason for a book, and why write a book? I don't know if any of you have ever attempted to write a book, or if you know any authors who actually do write books for a living, for a profession, but writing a book is hard. I had no idea when I wrote the very first book, Intelligent Investing. I thought, gee, this will be easy to do. And then I sat down and started handwriting it out on a spiral notebook, and wrote and wrote and wrote, and then would set it down. That first book probably took 4 years to actually write. Writing a book is hard, and it's not something that comes to me naturally. I would much rather spend time with clients, helping them, ask questions, solving problems, than writing a book. So it is hard work. But what writing a book does, it really helps you to get clear about your thinking. So the first book was all about investment strategy, and it's how we invest. What I appreciated about doing this is it helped me to get really clear about how we invest money for our clients. In the process, I kept coming up with this reminder that behavior is so important for clients, for investors' success. So I would set aside notes separately and just think about investor behavior. And that really was the impetus to writing Blind Spots, which is improving investor behavior. So I have a desire to help people to improve their investment behavior as investors. So that's the reason for doing it, helping people to be better about that. So that's really the why behind it. What are some of your beliefs about investing and about wealth? I wanted to flush those out. I wanted to flush out the fact that your attention is really your property, and attention is something that everybody is trying to get a hold of. My industry, the financial services industry, is very loud in getting and attempting to get people's attention. And why? Because they are motivated by you making changes. And so investor behavior, getting people distracted, getting people to change what they're doing, is something that is inherent in our industry. Sadly, so much of our industry is all about selling, and that if you haven't figured that out, just be aware that is the case. So investor behavior is something that you can control. What you cannot control are things like the economy. You can't control the markets. You can't control volatility. You can't control politics. You can't control all of that noise that's all around us, that's seemingly very loud. But what you can control is how you think about things. You can control how you react, how you respond. And that's what I wanted to try to really get across to people. So your behavior has a much bigger impact on your financial success than what the markets do. Yes, your behavior has a much bigger impact. What do I mean by that? Well, the very first premise of that is how much you save has a much bigger impact than the rate of return that you have. So that's why we try to instill really good investor behavior by encouraging people to save regularly, systematically, periodically. So the savings rate is super critical. What's the ideal outcome for the book? Well, that you receive a straightforward message and you don't let yourself get distracted, which again gets back to attention, that you can control your emotions. And frankly, it's a matter of looking in the mirror and really understanding what your emotions are, preventing you from making those big mistakes. That's really the goal. So when we think about investors, the obvious question is, why do people invest? And from the first book on intelligent investing, we talked a lot about why you should invest, why people invest. And the reality is it's all about income. People don't spend the value of their portfolio, they spend the income off of their portfolio. And that's why we are very strong believers in investing in businesses that reward the fellow shareholders in the form of dividends. And they also reward those fellow shareholders with rising dividends. That then helps to protect people from the ravages of inflation, the headwind of inflation. So that's much of the why people invest. When you're thinking about being an investor, it's critical that you have an investor mindset, what we call an ownership mindset. You heard me refer to investing in businesses that pay dividends. Well, some people will say, what about stocks? Well, stock just happens to be the form of ownership, but it's the attitude of being an owner in the business that is so critical. Because when you invest in stock, you become a fellow owner with other owners in that business. The mentality of being an owner is critical. Let's talk a little bit about what I call being self-aware. What are the natural errors that people make, the natural mistakes, the blind spots that people make? Well, one would be the example of anchoring. What does anchoring mean? Anchoring is a mentality when you anchor a price or you anchor a level, and that becomes a mental marker for you. So a good example of anchoring would be when people think about their portfolio and they remember that the highest level in the portfolio, and let's use a number, was $3 million. Well, and today the value of that portfolio is maybe less than $3 million. Anchoring is when you have in your mind that $3 million level. And you have a choice to decide how you feel about that. That nominal number where it was just happens to be where it was at a point in time. If today that amount is lower, you have a choice to either feel bad about that feeling, gosh, it's down in value, or I've lost money, you're anchoring to that previous high level. The reality is nobody's lost any money because you haven't sold anything. The only time that you realize any losses is if you buy something or invest in something when it's high and then turn around and subsequently sell it when it is low. So the mistake that some people make about anchoring can really lead to doubt. Another example of anchoring would be with residential real estate. So, here in Denver, Colorado, residential real estate has been really hot. We've been in a very hot market. Excuse me. If today's value is less than what it was 6 months ago, you are anchoring to the prices where they were 6 months ago. And you have the choice to decide, how do I feel about that? Do I feel bad because prices are lower, or today's price is lower? It's just a mindset. And we encourage people to be careful with anchoring. In other words, don't anchor. Another blind spot that we bring up, and we talk about in the book, is what we call confirmation bias. And confirmation bias would be a belief that you may have about a particular asset class or about a particular business. And people tend to attract people who think in the same fashion as they think. So people who may have a bias toward real estate tend to surround themselves with other people who have a bias toward real estate. Well, that's confirmation when you're around other people who think the way you think, and that creates a bias. I might have a confirmation bias about owning businesses because I believe that ownership of businesses is the best way to protect the purchasing power of your money. So I may surround myself with people who similarly have an attitude, have a bias toward owning stocks or owning businesses. That's a confirmation bias. The key there is that you're self-aware, that you realize, oh, I have this natural tendency, I have this natural bias. And you need to pull yourself out of that natural bias, that confirmation bias, and look outside the box, so to speak. Another example that was so true in blind spots, and it's a issue with people, and that is loss aversion. So if people are afraid to lose, or if it is more painful for them to see prices temporarily lower, that loss aversion can lead to being frozen. That can lead to isolating yourself and not being willing to look toward the future and have confidence about something. Loss aversion can really hold people back. The fear of losing can really be devastating. There have been studies on this, which I think are fascinating. Studies that show that it's twice as painful to lose 10% in price than to gain 10%, which is just really interesting. So it hurts twice as much when things go down by 10 than when they go up by than the feel-good feeling that you have when things go up by 10. That's a reflection, that's a psychological reflection of that whole issue of loss aversion. Another example is fear of missing out or comparison. Roosevelt, I believe it was Teddy Roosevelt, that said that comparison is the great thief of joy. So when people compare themselves to others, somebody's always got more than what you have. Somebody's always more handsome or thinner or this or that. And that comparison trap can be quite dangerous. We prefer to have people think about their progress, That's why when we sit down with clients and look at portfolios and look at their progress, what we're trying to understand is what progress they have made since the last time we sat down, or since the last time that they took that picture. Fear of missing out can be compared, it can be seen when you compare yourself to what your neighbors are doing or what someone else is doing. It's a real dangerous thing to do. They don't know that you're comparing you with them. And frankly, who cares? What matters is what's working for you. Kind of a last area, a last blind spot is a blind spot of regret. When people regret not doing something that they could have done or they think they should have done going back in history. Well, the reality is you can't turn back history. You can't turn pages back. What you can do is you can remember how you felt. Think about that. Remember why you made the decision about whether you chose not to do something or to do something. And then what did you learn from it? So regret is, something that is quite dangerous. Again, it gets back to being self-aware. Are you aware of your natural blind spots? So what you can control are things like your savings rate, how much you save, how regularly you save. You can control an attitude of ownership, an ownership mentality. I read a book 25 years ago called Act Like an Owner. And the best part of the book was the title. It was very heavy academically, but the very best part of it was the title, Thinking Like an Owner. So when you walk into a Costco and you look around and you realize, I own some of this business, or you buy a Procter & Gamble product, or you go into a Starbucks coffee shop, realizing that you own part of this business. You may own more of the business than the barista behind the counter, but you own part of that business. That attitude of being an owner really helps you. And what it does then is it takes away the pricing, today's pricing. So if Starbucks happens to be down in price, it really doesn't matter. Starbucks is selling more coffee. They've figured out how to they've figured out how to raise the prices very effectively. They've figured out how to control their costs and widen their profit margins. When you think about owning a business like that, that's the attitude of an owner. And that's a very mature way to think about how you've invested your capital. So I love the idea of ownership. And again, that's why when we are in conversation, we talk about owning businesses. We don't talk about owning stock, but we talk about owning a piece of the business, because that's what you do. How you respond to mentality is another element that you can control. Volatility has been with us, will always be with us in the future. It is today, and it will always be tomorrow. The media does everything in their power to get your attention, to take your attention, to steal your attention. And what I would suggest is that you are very careful with who you let have your attention. Don't let people steal it. Don't let the media steal it. That's why we have a mute button on our remote controls. That's why we can turn things off. That's why you get to choose when you turn things on, when you listen to the content that bombards you. So how you respond to volatility, that's your choice. We get excited when there's volatility because we like to be buyers in that volatility, especially when prices are down. Why? Well, when you're accumulating businesses, buying them when the prices are down is a great way to position yourself for future profits. So don't get distracted. Don't follow what we would call financial clickbait. Don't listen to all that noise, because what they're trying to do is motivate you to make a change. One of my favorite thoughts, everyone's heard the saying that children say of mind your own business. Well, one of my mentors, who I think is a fabulous teacher on valuation, describes it this way: mind your owned businesses. In other words, pay attention to what you own. Mind your owned businesses. And that's what we like to do. We like to see how those companies are doing, see how they're improving their business, how they're improving their profits, improving their dividends for fellow shareholders, for you, for us. Again, this is a part of what you can control versus what you can't control. Kind of the last area in terms of what you can control is you can control when you make investments. And it's very important to understand when you make that investment. What I mean by that is, are you buying it when the value is very, very low versus the price, or are you buying it when the value is high versus the price? Obviously, we try to invest in businesses when the price may be here, but the valuation may be much, much higher. We look for discounts to the value. Valuation really matters. And I think about, that little coffee company, Starbucks. Starbucks was way overvalued a year and a half, 2 years ago, when it was selling at a quite a high price. COVID hits, valuations fall, or excuse me, prices fall, but the valuation of the business continued to increase. Why? They continued to find ways to sell their products and widen their margins. So the price went down, valuation went up. That's what you want to do, is be a careful investor, buying assets when the price is way below what the value is. So those would just be some of the thoughts that I would have about blind spots and about mistakes that people make, natural blind spots that people have, and then what you can control, thinking about what you can control. So if you have questions, if you would like to have some questions answered about this whole concept, we would welcome them. The best way to forward those questions is to forward them to my email address, steve.booren@lpl.com, where you received the invitation for today's kind of open house on blind spots, the kickoff of it. So are there any questions that have come up, Kyle?
Let me get my mic turned on here.
Sure.
Let's have a look here. So again, guys, if you have any questions, please feel free to send them to Steve's email. I'm keeping an eye on it right now, and we'll happily relay those to Steve. Okay, I've got a question for you, Steve. In the book, you encourage us to find our why for investing, the reason that we choose to invest. What's your why for investing?
Well, my why gets back to the only reason why people save money is, I believe, is for income. It's either income today or income tomorrow. And if it's income today, you might be in a mode of retirement. If it's income tomorrow, it's income that you're setting aside, or cash flow you're setting aside for income when you decide to turn it on, when you decide to retire. So my why for investing is to generate cash flow for our clients, cash flow that is secure, meaning it continues year after year, cash flow that increases. Rising cash flow solves a myriad of problems. And what the value of a portfolio might be worth is sometimes interesting, sometimes it's entertaining, sometimes it's scary. When it's scary, that's most often when things are very attractive to buy. That's most often when it's time to add or push more capital, more money toward investment, when prices are down. Because the reality is prices are down temporarily. That's what market corrections are. It's a temporary decline that's then followed by a recovery in price and then to a new high value. And why do we say that with such confidence? Why do we believe that? If you just look at history, if you just look at facts, that's what has happened in the markets over a long period of time. Prices do fluctuate. When they fluctuate down, it's always temporary. And those times when prices fluctuate down, that's the time to be a buyer. You know, the financial services industry is fascinating. I'm a bit of a student of it because I've only done it for 44 years now. But ours is the only industry that when prices go down, people want to go to their pantry and get the things that they bought last week and rush them back to the store and turn them back into cash. Normally, when prices go down on goods and services and things that we buy, that's when we go to the store and buy those goods and services. Well, our industry it's again, psychologically, it's fascinating. We go to the pantry, we go and we try to we try to take what we bought last week and return it because it's temporarily gone down in price. So human behavior is fascinating, especially as it relates to investing. Which is why I wrote the book, Blind Spots.
Which, speaking of, Steve, there's a great example that you touch on in the book. You say that you can get to know someone really well by asking what their experience was around the kitchen table as a kid. And you share your experience around your kitchen table as a child. Can you tell us a little bit about that example?
Sure, you bet. I was raised in a home that as I look out the window here, I can see where I grew up at Orchard and University. Fortunately, I have a nice view of that. I was raised in a home where money was scarce. And we weren't poor, but money was scarce. And my parents, they held on to their money with a very tight rein. They gripped onto it rather tightly. And I believe that we learn those habits about our money, those habits about money in general at the kitchen table. I believe a lot of it occurs as you're growing up. So if you see your parents either arguing about money or not talking about money, well, if they didn't talk about money, there's a high probability that you may not talk about money with your family, with your children. You may be afraid to do that, which, is not necessarily extremely healthy. I think it's good to talk about it. It's good to be transparent. My parents, they hung on tight. I'm amazed as I think about how my mom could stretch a $20 bill between groceries and getting her hair done every week. Groceries for two boys and my mom and my dad. I'm pretty amazed at that. So I think we learn we have a lot of our natural beliefs, our natural instincts based on how we were raised and how money was discussed while we were raised.
So along those lines, you talk about beliefs as they relate to finance, and how a lot of those beliefs are created when you're young, maybe around the kitchen table. Beliefs like only the rich get richer, or investing is only for the wealthy, or all of these beliefs that have no grounding in either fact or reality. You've been investing professionally for over 40 years now. What are some of the beliefs that you had when you started your career that have maybe changed over the past 4 decades?
Yes. One of those beliefs, I was educated and taught, both academically as well as in real practical experience, was that we have different life cycles of life. We have conception when you're born, education. So the first 20 or 30 years, you have your avocation from age maybe 25 to 65. And then you have recreation from 65 to when you exit, when you pass. The financial services industry has a mentality, has a belief that during the accumulation years, when you are in your avocation, when you're in your job, that you need to save, save, save. And all of your savings, the investment strategy for savings, investing during that period of time, is growth. It's all about growth. And if you have experienced this with other investment advisors, they will have an investment objective of growth until suddenly you decide that you want to retire. And typically that might be at 60, 65, 70. So it's really your choice. But at that moment, your investment objective changes from growth to income. And it's like flipping a switch. Well, that strategy might academically make some sense, but that strategy is a very dangerous strategy, because your timing of when you decide that you want to push back from your avocation, if it coincides with the market being down, well, now you may have flipped the switch to move out of things that grow into things that generate income. Worse yet, if you decide to do that when the markets temporarily are down and interest rates are very low, well, now all of a sudden, the money that you've built up, it takes a whole lot more money to generate income when interest rates were like they were a year ago, 2%. So that mentality that you academically invest for growth and then you invest for income. Again, I was educated in that, getting my training, my first 20 years in a we call them wirehouses, but in a larger investment firm. Then being educated and experiencing the risks of that for and with clients, and seeing that that does not work, that's really shaped our investment philosophy and our investment strategy here at Prosperion. Another would be the attitude that your age, however old you are, in other words, your actual age, that age should coincide with how much money you should have in fixed income or bonds. Well, people call that a balanced portfolio. Balanced, that strategy last year performed worse than what just investing in the market performed at last year. And last year was a really hard year. So a balanced portfolio had poorer performance than just a pure equity portfolio did in 2022. So it's mindsets like that, mentality, thinking like that, that can be dangerous. So.
One other thing I want to touch on, in the book, you spend quite a deal of time discussing attention and how attention is quickly becoming a new form of currency, and that people are trying to get you to spend your attention on all matter of things. Can you expand on that a little bit?
Yeah. I believe your attention is your property. And I referenced it earlier, but it's your property. Don't give it away. Don't let people steal your property, which stealing your attention is something that again, the media, advertising has either very loud and also very subtle ways of trying to influence your thinking. You can go to a movie, and in the movie, you can see someone who's doing something, and in the background, you see an Amazon Prime truck go by. Well, Amazon paid to have that truck go by, to have your eyes see that. That's your attention. And I guess my point of that is, don't let people steal your attention. It's your property. Be careful with it. Be careful with it.
In the book, you liken strengthening your emotional muscles to your physical muscles, going to the gym. Can you tell us a little bit about how we might go about strengthening our emotional muscles for better outcomes?
Yeah. Well, I do enjoy exercise every morning and do that to make sure that I stay sharp and strong. But when I get on the exercise bike, I can't stay on the exercise bike for more than 40 minutes, because at that point I'm starting to exhaust. So I have to get off, rest, rejuvenate, relax, let my muscles recover. I believe the mind is much the same. I believe that there's only so much you can take in with your mind, and then you need to stop and let it recover. So, I encourage people to read different perspectives, listen to different perspectives, but then recover, sit back, rest. Don't react, because reacting, if you are reacting when your muscle has just been exhausted, you might make the wrong judgment. If you react when your mind is maxed out, you might make the wrong decision. You might make the wrong choice. And what we want to try to make sure is that people are not reactive, and that people don't make what sometimes we call the big mistake. Great example of that was March of 2020, when in 31 days, the market dropped by 33%. Well, why did that happen? It's because the government shut down our economy. They did a full hockey stick shutdown on that, and prices fell rather sharply, rather quickly. I feel for the people who reacted during that period of time, thinking, oh my gosh, it's going to keep going lower and lower. They took 2 data points and they extrapolated. They said, well, if it was here yesterday and it's here today, tomorrow it's going to be way down here on the floor. So I better get out now. I referenced an example of some clients that did that, former clients, but clients that did that. And we tried to coach them along the way and say, no, this is temporary, this is temporary. Well, lo and behold, they pulled the trigger and got out and guaranteed themselves that loss. Well, then 6-8 months later, we all kind of know what happened. The market went down 30% in 31 days and recovered in about 2 months. These clients called back after we had encouraged them to find a new advisor. They called back in the fall of 2020 saying, okay, it's time for us to get reinvested. We can't really help them. we want to try to make sure that people don't make those big mistakes. But if they do make that big mistake, it's their choice, and we really can't help them. So we work diligently to make sure that people don't make those big mistakes.
Okay. Again, guys, if you have any questions, feel free to email Steve. I'm happy to relay those to him. I want to switch gears just a little bit, Steve, and ask about the process of writing a book. I know, and you know that we started writing this book several years ago now. So it's great to reach a finish line, as it were. Tell us a little bit about that process and what it's like to conceptualize, create, and release a publication like this.
Well, Kyle, you know, maybe more than I know, it is hard work, especially if you don't naturally write. And I'm not a natural writer. I'm probably more of a storyteller than a writer. And yet the very best books are books where it's told as a story. So I've at least learned that. If you want to write a book, I would encourage you to think about what your motivation is. What's your purpose? What are you trying to accomplish? And you may want to share your story. You may want to do something as a legacy for your family. You may want to do it because you want your viewpoint to be out there. But, you know, figure out what you want to accomplish. What's your motivation? Then figure out what difference will this make? So if I write this book, what's the difference going to be for people? Well, my goal was to improve investor behavior, to help people to realize what their blind spots are, to bring them to surface. So you need to figure out what you want to accomplish, what the impact would be. Then lastly, what do you want this to look like when it's done and done really well? And what's the payoff? What do you want that to look like? Then once you've gotten really clear about the purpose, the importance, and then the ideal outcome, then I would encourage you to write the table of contents. Think about your message. Think about the points you want to make. The table of contents can be a wonderful way for you to organize your thoughts. So lay that out. This book and Intelligent Investing, they're not big, thick books. Research says that books that are, under 200 pages, something like 85–90% of them get read cover to cover. Books that are over that go down dramatically in terms of whether they get read actually. I received a textbook for Christmas from a partner here. And the very first thing I did is I went in and I looked at the table of contents and I said, okay, which chapters do I want to read? And out of, I think, 30 chapters, which is mind-boggling, out of 30 chapters, I read 3 or 4. And I got out of that book exactly what I was looking for. So write your table of contents. It's a great organization tool. Then figure out what type of a writer you are. Some people write very well on a keyboard. Some people write very well by hand. Some people write very well audibly. And I've tried all 3, and I've figured out what works best for me. But try those. There's some wonderful apps that can help you do it audibly, where you just sit down and have a conversation, and that'll transcribe that for you. So it takes it from your voice to written. And in a very big way, it's doing a lot of the work. Now, there's a fair amount of editing that needs to go into that, but figure out the best method for you, whether it's with a pen, a keyboard, and a mouse, or to do it with a microphone. One of my coaches writes 4 books a year, 1 a quarter. He writes a book, and he takes an idea, he lays out what I just described. What's the purpose? Why is it important? And what do you want the ideal to look like? He then lays out some questions and has someone interview him. It's recorded. They take that recorded transcript and put it into a book. And that's how he gets 4 books per year out. It's remarkable to do that. So figure out what method works for you. I would encourage you to do it. Again, what it helps you to do is get really clear about your thinking. It causes you to think about your thinking. It causes you to get really clear about what you believe. And it can challenge you in terms of writing those beliefs down and then comparing them with actual. So I encourage you to do it if you're looking for a project, but it's work.
Well, Steve, that just about brings us to the end of today's program. Are there any other thoughts that you'd like to share before we sign off?
You know, again, I am humbled to do what I do. We get to help people. We get to help people with their problems. We get to help people with their concerns. We happen to be paid by managing their assets. But the reality is we get to be in relationship with people and help people. And I'm just so grateful that I'm able to do this. Intellectually, it's incredibly stimulating. Emotionally, it's incredibly rewarding. And it gives us freedoms. We have the freedom to help people that we like to help. And just incredibly grateful to you for you spending time today with us and for being a client of Prosperion. So I'm grateful. Thank you.
Thank you, everyone, for attending today. We do have books on order. As soon as they arrive, we'll be happy to send out a copy to you. We appreciate the investment of time today, and thank you so much.
Bye-bye.